Bitcoin and all cryptocurrencies have been on a rampant tear since the election, reaching record highs and trading above $90,000 USD. Bitcoin has rallied 30% since the election and 114% on the year. Is there more room to run? We have a lot of questions, but we have a very, very special guest for you here today. We have Kuiper joining us from Fidelity Digital Assets. And for background, Fidelity Digital Assets is a subsidiary of Fidelity Investments. They have a sole focus on digital assets and research. So welcome, Chris. Thank you for joining me today on Fidelity Connects.
Yeah, thank you, Andrew. Great to be here.
Yeah, it's been an exciting time for the digital asset space. I think we've already had Canadian Thanksgiving. I know you have yours coming up this week, but it was a center of topic at the dinner table, at least for my Thanksgiving. Can you give us a little bit of background of what's happening in the markets, kind of what you're seeing from your stance as Director of Research?
Yeah, so last year around this time, Thanksgiving, we were still in a bull market. 2023, Bitcoin went up 155%. And this past year, 2024, we're up even more. So, of course, we had two bookends to this year where we had the surge at the beginning of the year that coincided with the approval in the US for the exchange-traded spot Bitcoin products. And then we had a long summer of just chopping sideways, going down a little bit. And then, of course, the post-election surge that you mentioned here, where we're almost hit 100,000 US dollars here. So I know you hit that already in Canadian dollars, but we're still looking for that six-digit number. We didn't quite hit it yet. We had a bit of a pullback in the last week or past couple of days of about close to 10%. These are very normal, especially in such a rip-roaring bull market. And now we're rallying a little bit back to about 95,000 today. So certainly will be interesting Thanksgiving dinner conversation again this year for our Thanksgiving tomorrow.
Yeah, it is really interesting. So it's interesting to see what was driving the price action. I think we've had some shifts in it. Can you kind of contrast what was the rally pre-election? You touched on the launch of the ETF, the summer doldrums. We saw some uptick heading into the election. We saw the uptick post-election. Can you kind of just talk about what, in your mind, are the facts, what were the biggest drivers heading into and post-election?
Yeah, it really was a lot of movement around the election and what people were saying. For example, I was at the big annual Bitcoin conference in Nashville over late July this summer this year. And we heard from two presidential candidates for the US, Robert F. Kennedy Jr., laying out a plan for the U.S. to have a strategic Bitcoin reserve. And then, of course, we heard President Donald Trump lay out his plan and comments around it. So those are the facts that we saw. Now, of course, we have yet to see if these things will come to fruition, what they will be able to get done, or if they're going to act on all of these things that they said on the campaign trail. But we have seen a lot of movement and obviously a lot of sentiment. Some of the post-election surge could also just be due to the removal of uncertainty. Markets hate uncertainty, and to get an election results that were pretty well known right away, that was also a concern in the U.S. of whether or not the race would be too close to call, but it wasn't. So that, I think, removed a lot of uncertainty and volatility as well. And then we've had a few other political developments as well, or regulatory developments. We've had, for example, a senator here actually put forth a bill to create a strategic Bitcoin reserve for the U.S. So that's also being talked about. We had a number of governors and also state representative senators get elected that are crypto and Bitcoin friendly. So I think that's been looked at as well. And so we'll continue to watch this, but again, it all depends on what actually gets done, not just what was said.
Yeah, that makes a ton of sense. And we're seeing the other crypto assets rally. So Ethereum hasn't kept up to the pace of Bitcoin. Solana seems to outperform Ethereum just in recent months or weeks since the post-election. Can you just kind of talk about the other cryptocurrencies? Because I think all the focus has been on Bitcoin, but what are you seeing elsewhere across the landscape?
Sure. So we did see a rally in some of the altcoins, as you mentioned. I think some of that is due to the idea or sentiment that we're going to get clear regulation. And of course, at Fidelity, we work with these lawmakers. We want to have clear regulation so that we can move forward. We do think this space transcends politics. We've been here over 10 years through multiple administrations. So it's not just one administration, but we're looking over the long term to get clarity for the sustainable future for all of these things. So I think that was part of the rally. And then I think Bitcoin, as Bitcoin has historically done rallies first and hardest, and then sometimes you see in the second half some of these other tokens or coins rally as well. And so Bitcoin's leading, its dominance is increasing. In terms of the Ethereum underperformance, I think that's part of it. There's also still some concern in the Ethereum community on whether or not some of the decisions that they're making is the best path forward. So to put this quite simply, not get too much in the weeds, but Ethereum has had a long-term vision of giving up a lot of near-term revenue opportunities for the sake of getting more users. So there's this inherent tension with these things and these platforms where Ethereum wants to make fees cheap for its users. That's going to attract users. They like cheap fees. That's going to allow them to transact more on the Ethereum network. But then, of course, cheap fees are not as good for the network as a whole in terms of its revenue, its fees, and what is given to the token holders of Ethereum, the Ether token holders. So that's one of the things we're going to continue to watch as they progress down this roadmap. But it's a long-term vision. We'll see how that plays out. And then you have the others like Solana that are taking a little different approach. So all of these things are trying to find their product market fit. But we're pretty adamant that investors should really look at Bitcoin as a completely separate category in its own right. We think of it as an emerging monetary good, as an aspiring store of value. And then there's everything else that competes on different aspects. And there's a lot more competition because of that in that space.
That makes sense. And I think I read a paper probably a while back that you view Bitcoin investment thesis significantly different than that of altcoins. But you recently wrote a new one, Bitcoin's potential as a leading macro asset. So I often get asked the question is, what is Bitcoin? Where does it fit in my portfolio? I read this paper, quite interesting. Can you kind of walk us through that view of A, what is a macro asset? And then why is Bitcoin fitting this profile?
Macro asset is one of those terms that gets thrown out a lot in finance. And in finance, we have these terms that just take on their meaning. Nobody really decides what their definition is. So it is helpful to lay this out. To me, a macro asset is something that trades purely on large aggregate macroeconomic indicators, things like GDP, inflation, monetary aggregates, that sort of thing. So even a stock index would be a better macro asset or indicator than an individual company, because that individual company is going to be affected by a lot more and more microeconomic factors. So a macro asset is something that investors will look to either get exposure to something like a trend, or if they have a variant perception on where inflation's going, they might want exposure to it, or they might want to try to hedge that exposure out. And they say, I don't know where the macro economy is going. I want to focus on individual companies. And so they'll look to hedge that out with various vehicles. So that's what a macro asset is to me. And I think Bitcoin fits this perfectly. The fact that it has no dividends or cash flows makes it even more of a pure macro asset, more of a monetary good. And then it also has other characteristics that make it a great macro asset. It's traded over the globe 24/7, 365. It's completely homogeneous, unlike things like even different grades of oil. There's no different grade of Bitcoin. A Bitcoin is a Bitcoin around the world. So completely homogeneous, very liquid. People can access this and transact in it at any time of the day. And we've seen this in bouts of volatility, people accessing the Bitcoin market to either reduce leverage or find cash or sell something in times of panic. And then the other part that we go into in the paper is, okay, if this is a macro asset, what are the big macro factors that are driving it? And our research has found the two biggest ones are liquidity or monetary aggregates. So if you think of things like broad money supply, M2, either in the US or globally, and then also inflation expectations. And the key is expectations, changing in expectations, not the rear-looking inflation number itself.
That makes sense. So let's dive into that, because I think one of the pushbacks that we received is we went through one of the biggest inflation spikes that we've seen since the 70s. That was coinciding with the period of Bitcoin probably just staggering around, not doing too much. Can you explain the difference to the audience between the change in expectations and the price of Bitcoin and the actual inflation prints and kind of how that dynamic played out through what we've seen in terms of gains in the Bitcoin price, and then bring it back to the inflation expectation aspect of it.
Yes, you've hit it right on there. And if people want to see this report, just go to fidelitydigitalassets.com. You can see all of our reports and research for free there. So this is one of the latest ones that's up there, and you can see these charts, but I'll just explain them verbally for now, which is if you look at, for example, in the US, as you said, inflation went to its highest level in 40 years. We were at over 9% CPI here. And Bitcoin had rallied before that, but then it started crashing. And so Bitcoin was going down and went down even further as CPI continued to go up. And of course, people threw up their hands and they said, what gives? I thought Bitcoin was this inflation hedge because it has this hard, credible cap of only 21 million. If there's this hard supply cap, this is supposed to be a way to hedge against inflation because you can't print more Bitcoin. It's got a monetary schedule that's set literally in stone in the code. And if you dive into it, what you see is Bitcoin as a market, a pricing market, is forward-looking, just like equity markets, just like anything else. So if you look at the change in inflation expectations, and especially if you look at these long-run expectations, those expectations doubled before this. And Bitcoin, at the same time, went up over 800%. So Bitcoin rallied along with inflation expectations going up. So I personally think it was the perfect reaction or hedge against that. But of course, CPI, Consumer Price Index, that's a backwards looking metric. So it only looks at how prices changed over year over the past month or two. And so by the time it caught up to that, Bitcoin was already looking forward ahead again and thinking, oh, inflation's coming down, which it did. And long run inflation expectations were not going to be as high. And so I think that squares part of it. Now, of course, that's just correlation, not necessarily causation, although I do think there's a sound economic theory there. But we only saw this one time. So to be fair, this is the problem. We can't run these things in a lab and rerun them like an experiment. So we'll see if this continues or the next time this happens, if the same relationship or correlation holds.
Yeah, that makes sense. And for everyone's background, if you want to look at inflation expectations, the St. Louis Fed posts the break-even inflation, and that's the forward-looking metric on their websites. But you brought something of interest here. So gold, one of the longest track records in the world in terms of we can go back many decades to see how the price of gold's behaved. I often get the question, is Bitcoin competing with gold? So I'm curious for your thoughts on Bitcoin versus gold.
Yes, one of our most downloaded reports, and I think we've even talked about it on the show before, it's called Bitcoin First, why investors need to consider Bitcoin separate from other assets. And in that paper, we have a table, and other people have made tables similar to this, where if you look at money, and it's a weird thing to think of what is money, but economists and historians have looked at money over the centuries and millennia, and they said, what makes good money? Why do some things become money or people use money and other things don't? Why did at times in history we've used shells or livestock or something for money, but most of the time we've used something like gold? Well, you look at different characteristics of what makes a good money. You want it to be homogeneous, it's the same. You want it to be verifiable, you can see that it's not fake or forged. You want it to be divisible, to make small transactions. It's hard to cut a cow in half if you need to, right? And so in this table, we go through all of these properties of what makes good money. And gold has a lot of those characteristics, but it doesn't have some of the characteristics of fiat money, which is more divisible, more verifiable, easier to send and transport, that sort of thing. But Bitcoin does have those characteristics. So in our opinion, it does, purely from a monetary standpoint, have some of the key characteristics of gold, but also improves upon it. And so in some ways, as just a pure store of value, I think it does compete. And so another question we get is, how do you value Bitcoin? Well, a very simple way is just to look at the market cap of gold compared to the market cap of Bitcoin and think about how much it could take of that market. Today, gold's 18 trillion US dollars, close to that. Bitcoin's around 2 trillion, so 10% or less. And you can do this exercise at home and think of what the price could get to if it's going to take 20, 30, 40% of gold's market cap. But it's more than that. So we think that the use case extends beyond just that. And if you look in terms of your question of how it fits in your portfolio, it actually has a really low long-term correlation to gold. It's around 0.2, zero point 0.3 Bitcoin's correlation to really every asset class in your portfolio, stocks, bonds, even hard assets, real estate, commodities. They're all very low positive correlations. So it really stands as a separate asset class, at least in my opinion, and something completely different.
Yeah, it makes sense. I think we were looking at the numbers, at least internally on our side. The 3-year correlation's looking at about 30% to equities, 0 to bonds. I don't have the number offhand versus gold, but it does seem to be a diversifying asset. But that kind of gets me into the conversation. So the ETF market. You and I chatted about this before the show. Most successful ETF launch in the history. Can you kind of touch on what you're seeing in the U.S. Since the evolution of the Bitcoin ETF?
Yes, we got the approval at the beginning of the year, which coincided with Bitcoin's massive price run. As you said, most successful ETF in the history of ETFs on really any metrics you count in terms of asset flows. Speaking of gold, all the US-based ETFs, assets are about 80% of GLDs now, one of the most popular gold ETFs. It took GLD years, if not decades, to get to this point, and we've done it in less than a year. So it shows you exactly how fast this has happened. We've had the highest number of institutional investors own this product if you look at their 13F filings. And it's one of the most traded products out there and traded ETFs out there. So absolutely smashing success. We had a huge net inflow at the beginning of the year. We had that consolidation this summer that we talked about in the middle of the year. And now we're seeing big inflows again. Just last week, we had another $1 billion positive net inflow for just one day, multiple billions over the last few weeks here. So it's going to be very interesting to see where this goes. Obviously, there's still a lot of momentum there. And to your credit, you've been having more products in Canada, but in the US, there's still a lot of advisors and a lot of markets that I talk to where they're not allowed to actively solicit these. They're not allowed to put them into model portfolios yet. So I think even though it's well known, it's underappreciated that there's going to be a long, slow burn for these products as they continue to get integrated into portfolios and workflows. And that's just going to provide a consistent inflow and bid for these over the next 12, 18, 24 months even.
Is this the first asset class that Main Street's taken to Wall Street?
I think so. I haven't had anyone tell me otherwise. If I look at the financial history of things, it's quite unique in that's exactly it. The average person actually had probably more of an advantage because they're the ones, it starts at the fringe, and the techies and the people who want to adopt things early, they could go out and they could buy Bitcoin before anyone else could, before it was packaged up into these things. But it's a technology like other things. It goes through that adoption process, and I think 2025 could be the start. I mean, it's going to take years, but it could be the start of that next phase where it crosses the chasm, where it becomes more mainstream, or at least from what I see in my opinion here.
So you touched on the bull market earlier. We chatted a bit about this before the show. Kind of in the context of historical bull runs, do you think we're beginning, middle, end? What are your thoughts on where we are today?
Yes, past is not indicative of future performance, of course, but if it is any prelude, we have seen regular cycles. For those interested, we have another report on our website that we update quarterly. It's called our Signals Report. And we look at all these on-chain signals. So on-chain are metrics that are derived from looking at the actual blockchain of Bitcoin and Ether, for example. So this report goes through and it groups these different signals into buckets. Short-term, less than a year; medium-term, 4 to 5 years; long-term, beyond that. So long-term investor only cares about the ultimate health and that the investment thesis remains intact. But what you're talking about here is what we would define as medium-term, these 4 to 5 year cycles. And we look at all these indicators together, and of course they're not perfect, but if you take them all together, right now, at least in our opinion, they're saying we're well into the bull market. We're probably even over halfway through. But historically, the returns are not symmetric. There's multiple more returns, at least historically, that have happened in the second half of the bull market. And that's also where most of the volatility happens. So The big question, of course, is as this becomes more mainstream and as this asset class gets larger, do these things dampen over time? We have seen historically the returns of each cycle get smaller and smaller and smaller. So we may see that, but at least what we're looking at now, we're well into it, but we could still have quite a bit of room to go over the next year or more.
That's fascinating stuff. So something piqued my interest that you commented on in the volatility. Do you subscribe to the thesis that with larger adoption, we should see volatility decrease? Because I've seen it come down to some degree over the last several years. But can we talk about the introduction of the options market, the introduction of the ETFs, and just what widespread adoption of an asset class does to volatility of an asset?
Yeah, so we have a great chart in some of our reports as well that shows how Bitcoin's volatility has declined over the long term. It goes up and down a lot, but if you draw a regression line since, over 10 years ago, it's downward sloping. And this should make sense as the market cap gets bigger. It doesn't necessarily have to. I mean, there's actually mega market cap companies. Think of some of the Magnificent Seven. Yeah. And we have a chart on this as well, that are actually more volatile than Bitcoin right now, depending on what time frame you look at. So if anyone thinks Bitcoin is too volatile for your portfolio, ask them if they have any of these mega cap stocks in their portfolio, because some of them are actually more volatile than Bitcoin. But I think it makes sense. Academic research has shown that when you introduce derivative markets, more products, you have more ways of investors expressing their opinion, more ways for investors to take on volatility. The ones that want volatility have the option to do that. The ones that want less volatility now have ways to strip out some of that volatility or hedge it if they'd like. And this is just part of the financialization process. And going back to gold, at least in the US here, it was illegal for the regular consumer to own gold until the early 1970s. And that was also the time when we went off the gold standard completely. And so gold, which was fixed at $35 an ounce, now had this entirely new market, and it had to find out what it was worth. It had to go through a price discovery process. And it was very volatile at the beginning. The market is a process. It has to figure out what things are worth, and that takes time and input and decisions of millions of people. And I think Bitcoin's going through the same process. It's going through this financialization process, this price discovery process, where people are trying to figure out what it's worth. And as it continues to do that, its volatility continues to go down.
That makes sense to me. So we touched on it earlier, just Main Street to Wall Street. Can you just speak to some of your experience and your role and where you think we are at in the institutional adoption? So you touched on strategic reserve bills coming out of the US. Is this something that we could see going forward with more central banks looking to adopt it as strategic reserves? Are we seeing pensions? Are we seeing hedge funds enter the ETF space? Just some comments around where you think we're at in that stage.
Yes, we do an annual survey. It's a survey that we actually do. It's not of our own clients. It's over 1,000 institutional investors worldwide, though. And there's a pretty good number. Almost half are reporting that they're invested in some way or another. But if you dig into the data, it's a tale of two investors. Institutional investors to us also includes things like high net worth individuals, RIAs, and their clients. And they're much more, speaking of the Main Street to Wall Street, they're much more attuned to this and have gotten exposure a lot earlier. But on the other side of this, you have the big money, the pensions, the endowments that you mentioned. They're still at low to mid single digit adoption, very, very low. And they're the majority of the money out there, the pools of capital that would move this. And so we're starting to see just a few cracks. You can see public filings of a couple pension funds in the US now. With the advent of the exchange traded products, we can now see with the public 13F filings, certain state pensions that have purchased these ETFs. So you're starting to see it happen. And when that happens, then we're going to see a lot more adoption there as well.
Yeah, it's fascinating. I'm going to take a question from the audience. So your thoughts on stable coins and the role they play.
So stable coins have been a huge, somewhat surprise. They've been around for a while, but they've gained a lot of momentum. We're at now 150, 160 billion or more, I think, in terms of total market cap of stable coins. And they're obviously finding one of the best product market fits. Some people refer to them as the killer app of crypto. It's the one thing that everyone wants and it has a very clear use case. And so we first saw these being used a lot for trading pairs, people who wanted to trade in and out of different crypto tokens. They would use stable coins because they were crypto native and they could quickly get out of a trade and just go to something that's equivalent to the US dollar. Now we're seeing them used more and more worldwide, and this is one of their killer use cases for remittances. When some of the fees are 20+%, the average remittance fee, according to the World Bank, is 6.5%. If you can drive that to near zero, that's a huge quality of life improvement. People who want to get out of their country's currency that's highly inflating, it's constantly being debased. 2 billion people in our world live in very high inflationary regimes. So if they have a way out of that now with stable coins, access to the US dollar and other currencies, that's a huge benefit for them as well. The other part we're starting to see is whether these start to come to traditional finance. And I think that's what you're going to start to see more in the year ahead. You've seen a little more tokenization of things like money market funds, treasuries. That's, I think, the next chapter of where this goes.
Yeah, it's incredible how much more efficient they are than the SWIFT payment network in terms of moving money around the world. So we can do it in seconds now rather than days. But with that, I'm going to thank you for your time today.